The basic premise underlying the macroeconomic model would be savings, protection, and growth, three components, foremost of which is developing a sound savings habit, which is 15% ideally of one's gross income. And the reason for that is there's 5 factors that erode wealth. First is inflation. Second is tax. Third, miscellaneous, something such as the roof leaks or the basement floods. Fourth would be planned obsolescence. Anything mechanical has a shelf life and breaks down and needs to be replaced. And fifth would be technological change. And one can think of that as in 1990, basically you had a cable bill for $11 a month and no cell phone and no internet. And today it's routine that we would see a family spending in the neighborhood of $500 a month for those 3 things. Helping a client become fastidious in their savings habit is one of the key precepts of a model such as this. So ideally, we want to try to save 15% of gross income. And where that goes can be things such as the bank, 401k, stocks, bonds, mutual funds, cash value life insurance, encompassing protection components. But we also recognize that if somebody is not saving much or is only saving a few percentage points, we may want to work with that client over a period of years to get towards the 15%. 15% has become a mantra in the financial services industry, and it's designed to help people with the actual input or the money supply going into a model. At times, there's more emphasis on where the money goes and less emphasis on that the money goes. So the 15% has a track record of helping clients build a high level of financial security. During difficult times, if people cannot access capital, sometimes what happens is a credit card bill, credit card debt starts to increase at high interest rates with high monthly payments and becomes a drain and an inefficiency in an overall plan. So in difficult times, accessing some of the savings developed from previous 15% habit does become part of a safety net for people. There are things that no matter how well designed a plan is, things in life just come along that you could never even foresee. So being able to access capital at an arm's length very quickly with proper liquidity has helped many of our clients survive through tough economic times. Many times, specifically with younger couples, younger people facing high initial monthly payments, the mantra there is just to get started in some fashion with building a habit. Habits, as we all know, good or bad, are hard to break. So we want to get into a consistent habit. It could be as little as $50 a month, but just so the client gets exposed to the importance of beginning to put money away. And ideally, we want to start that at the youngest age possible.